going to talk about 4 strategies that professional traders use to stack the odds in their favor. To start, the rest of this video is just straight filler. All you need to know is 6 words: buy the dip and sell the rip. Backtested with 100% win rate. I'm obviously just joking. We're actually going to talk about established strategies that have consistently proven to work over decades. Finishing up with the famous bull flag.
Bull flags!
Bull flag.
The bull flag.
First up is the trend reversal strategy. This is a good strategy for beginners as it has easily defined entry and exit points. From the long perspective, you'll be looking for a stock that is having a major sell-off, and this could be happening for a various number of reasons. Institutions or hedge funds are unloading shares to the public, sellers panicking, or traders piling on the shorts due to a bad catalyst. Whatever the reason, essentially what we're looking for is a dramatic, sharp decline or an overreaction.
Don't put me there. Don't do it.
We are looking to exploit a bounce or reversal in the current trend that often occurs after such a violent sell-off. The overall trend may remain bearish, but as a day trader, we're looking to make money off fast intraday movements. There's 4 key criteria that must be met before considering taking a position in a reversal. Again, from the long perspective, number 1 is a minimum of 5 consecutive red candles on the 5-minute, each making a new low. Number 2 is an extreme RSI below 10, trading at or near support. And 4 ends with an indecision candle followed by a green candle that makes a new high. The indecision candles that you're looking for are called spinning tops, hammers, and dojis. You'll recognize them as overall weak looking candles. The main thing you must ensure you're not doing is catching a falling knife. You must wait for confirmation of a trend reversal. If upon confirmation the price trades sideways, it is likely consolidating for another drop. Exit the position as soon as you notice the reversal fail. It is never worth exposing your account to the unknown. A great example is Netflix. We can see the night before they got absolutely crushed on their earnings.
Netflix guided to the loss of 2 million subs in the second quarter. The company says things are going to get worse.
So many traders were predictably waiting to see what was going to happen the next morning. This is why patience and discipline is key when it comes to trading reversals. After 25 minutes, Netflix had already become a candidate for this strategy with 5 consecutive red candles and an RSI of 8. But it still took a further 25 minutes or so and an RSI of 4 before it found a bottom. And a prime example of why waiting for confirmation is essential to giving yourself the best probabilities of success. With each consecutive red candle and the further oversold the stock goes, there's an increase in the likelihood there will be a significant enough move in the opposite direction to profit off of. And it's just a matter of waiting for that indecision candle. Once it's established, followed by the first green candle that makes a new high, it's time to start looking for an entry. As it was selling off, you would have identified your profit target, and mine is the first technical level at the 13 EMA. So what we're looking for is if there has been a support established, and we can see that between these 3 candles. It's not uncommon to retest this level before the move is made. Entering here or as close as possible will maximize your potential reward. So my entry would be at $217 with a price target of $225 or $8 a share. And my price target must be at least double my stop loss. So at $213, I would be done with this trade. With the momentum behind it, if price action came back to this level, it would likely make new lows. As you probably know, the opening hour of the market consists of large trading volume and volatility. This time of the trading session provides many opportunities. If a particular stock gaps up in the pre-market, overnight holders might sell for a profit and new investors might jump in before prices go higher. The open is a battle between buyers and sellers to ultimately decide the direction of a move. The opening range breakout strategy is basically identifying the balance of power between buyers and sellers and betting on the team that comes out on top. Now the ORB is not as prominent as it once was when Tony Corbell first wrote his best-selling book. As in, if you decide you're just going to day trade the opening range breakout on the S&P 500, you'll be subjected to more false breakouts than you were, say, a decade ago. Don't just jump into the fight right after the bell. Wise traders patiently wait for the opening range to develop. Wait a minimum of 15 to 30 minutes for this range to develop and determine the highs and lows. You need the opening range to be smaller than the daily average true range. If a stock has already moved near or higher than its daily ATR, then it's not a good candidate for the ORB strategy. The average true range is a volatility indicator that shows how much a stock moves on average during a given time frame. If the opening range is larger than the daily average true range, the stock is too volatile and likely without a catchable move. This strategy signals an entry point but does not determine where to take profit. You should determine your profit target based on the most appropriate technical level. Okay, so let's look at VWAP. It had been a stock in play the last couple days with a bullish move in the pre-market. We can see on the daily that the ATR is getting wider wider, and on the 13th was 1.58. Back on the 5 minute, whether you waited 15 or 30 minutes, the opening range is between 10.7 and 9.94 or 76 cents, which is about half the daily ATR. A long entry would be when price action makes gains above the opening range. Ideally here on confirmation of the VWAP support on the retest, but as a beginner that's definitely hard to recognize in the moment. So let's just say we're a little late to the party and our entry is 10.74. My initial price target would be whichever is lower of the two, pre-market high or the opening range low plus daily ATR. Since the pre-market high of 11.08 is obviously lower than 11.52, this will become my price target 1, and the opening range low plus daily ATR will become my PT2. Minimum profit on the trade is 34 cents per share, so that automatically means that my stop loss is 17 cents below my entry at 10.57. At the pre-market high of 11.08, there didn't seem to be any resistance or a reason to exit the trade, but automatic profit taking should be something you get into the habit of doing anyways. At the very least, move your stop loss to right below your price target to secure the win on the trade. Once your second price target hits, you should be done with the trade for the most part. If momentum still seems bullish, you can move your stop loss up again and let the rest ride, but the risk reward is no longer favorable and you should be back to looking for better setups. Although it did end up running to $14 and $16 in the after hours, holding all day trying to catch a monster move is a gambler's strategy. But we're just about to get to how you can do it strategically while minimizing your risk. Before attempting any of these strategies with real money, practice with a paper trading account first to get a feel for how these setups work in real time. Make sure you're only paper trading with as much as you plan on trading for real to make it as realistic as possible. If you can't make money in a paper account, doing it for real will not make things any easier. Okay, so next up is the ABCD pattern. This strategy works well on medium to large float stocks as opposed to the bull flag on low floats. They're similar strategies with the main difference being where you take your entry. So like a bull flag, the ABCD pattern starts with a strong upward move where buyers are aggressively buying from point A to B. At point B, the price is already extended and it is nearly impossible to calculate an appropriate stop loss without risking immediately getting whipsawed out or placing it substantially lower than your entry. At point B, buyers who bought the stock earlier will start slowly selling for profit and the price will come down. At this point, you still shouldn't enter the trade because you don't know where the bottom of this pullback will be. Once you notice that a stock won't go below a certain point, which would become point C, you'll know that the stock has potentially found a support level. Once you've identified point C, you can start planning your entry and stopping points. The ABCD pattern is a very classic strategy and many traders look for it. As the price gets closer to point D, volume spikes as more buyers jump into the trade. Many traders wait for point D to be established before entering the trade to make sure the pattern is really working. But this approach lowers your potential reward and successfully happens less often. It is quite common for the move from C to D to retest the resistance at B, but less frequent for D to break out into new highs. An entry at C means you can take profit at D, move your stop loss up in case of rejection, or ride the breakout until the next technical level. We're looking at Lululemon because it repeatedly formed the pattern on its run from 278 to 410.
It was great to see, and it just shows the inroads we're making with great technical product into activities like run, train, and yoga, which are our core activities.
Once point B is established, we draw resistance and wait for point C to draw support. Getting in early on a large cap is not nearly as risky as penny stocks, but my entry would still be at the 13 EMA when it's confirmed to be acting as support on the pullback. Now this is where people get confused about the MACD. I think too many people get hung up on the histogram. In this area, it's still showing bullish strength as there's no divergence in the opposite direction as price action, and here it rejected bearish sentiment. You could determine price targets by looking at the previous day's price action and identifying potential resistance levels. Take profits on spikes for validation of your moving average. And of course, we have a tight stop loss right below the lowest point of C in case there happens to be a break to the downside. Okay, so finally the famous bull flag. This is essentially an ABCD pattern that will happen more often on low float stocks. It's one of the most popular strategies among momentum scalpers. Bull flag buyers buy at or near the breakout of the flag, which is the opposite of buying at point C of the ABCD. Low float stocks move very violently, especially with high volume. So again, it is essential to have confirmation of the breakout before entering a position. This time we're looking at ticker symbol LGVN with a free float of 4.37 mil. Again, we would draw resistance at point B and support at point C. You might notice sometimes that wicks fall below support or above resistance. This is not nearly as important as the most determining factors between the range of the body. You can refer to this as slippage, but if you Google what slippage means, you're going to get something different. This is why you want to wait for a candle to close before making a decision. The closing price has the strongest impact on the subsequent candle. You'll notice that indecision candle again. In the context of the price action, this is a bullish indication, and we're starting to see a bit of divergence on the MACD where it heads towards the 0 line as price action consolidates. We enter on the breakout of the flag or point D. Increased volume and a golden cross on this trade further reinforce that the bull flag is working. Now, if you're still not feeling confident enough to take these strategies and start raking in those gains, make sure to check out my day trading guide where I outline step by step how you can start planning profitable trades.
Even in this market, is that I never ask my clients to judge me on my winners. I ask them to judge me on my losers because I have so few.